Join us at Investments and Wealth Experience 2024, the year's premier event for wealth advisors and thought leaders from across the investment industry. The event connects advisors focused on expanding their knowledge, businesses, and network with wealth management's most successful and engaging thought leaders. Over 3.5 days, more than 1,000 industry leaders and advisors will gather in Las Vegas, a city known for never standing still. Attendees earn up to 21 Premier CE credits. Early bird pricing ends March 8th, so register today at www.iwicentral.org/experience24.
We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. So welcome to the Exceptional Advisor podcast. I'm your host, Bob Powell, and today I'm joined by a very special guest, Lou Harvey, the president and founder of Dalbar. Lou, welcome.
Thank you very much, Bob. It really is a pleasure to chat with you and to catch up.
It will be such a pleasure. And I should mention two things. One, in the interest of full and fair disclosure, I had a wonderful opportunity to work for you and for Dalbar from 1993 to 2000 or so. So that's 23 years ago, but it was a memorable 7 years I spent at Dalbar, I have to say.
Yeah.
I guess a couple things. One, my memory of my time there is that I was working for someone who was an incredible entrepreneur. And I've carried the lessons that I learned at Dalbar all these years later. So thank you for that, Lou. I appreciate it.
Oh, you're welcome, and thanks for the good word.
Yeah.
I hope I live up to it.
I'm sure you will. I have no doubt about it. So two things. Well, one thing. Before we get started, for the benefit of the very few people who don't know about you and your background, do you mind just giving us a brief overview?
Oh, sure. In the briefest form possible. I was born in Guatemala. I grew up and had my schooling in Jamaica, moved to New York, and then lived in Massachusetts. And in that time, entered the financial services business, initially in the role of what is today a registered rep, and have been through virtually all aspects of investments, companies and backgrounds and things like that. So to some extent, I have a technical kind of financial background, as well as all of the initiatives that we've engaged in at Dalbar over the years.
So I have in my mind a format that will talk a little bit about what you're doing today, a little bit more about the history of Dalbar, and then a little bit about your views about the industry going forward. So you've always been a rabble rouser, and you're working on some new projects right now. So walk us through some of the things that you're doing.
Absolutely. There's probably a common theme with what we're working on, and I'd like to give you sort of three aspects of that. The common theme is to broaden the service in the industry from narrowly being wealth building to include how to use that wealth. And part of the reason is the aging population, the changing needs, the growth in technology. All of those factors go into play, and we need to change, I think, the way we do business in this industry, from what one might call a factory mentality, which means, here's a formula, here's a solution, let's go find all the places we need to apply it, and turn that around and look at it from a much more personal basis, which I think is where the demand is going to be in the future.
So you said how to use that wealth. What does that mean? Is that more than creating an income plan?
Oh, yeah. It is actually spending. The income plan is a part of it, but you have key spending choices that generally in this industry we haven't really talked about and talked through. Make the assumption that the investor or the individual or the client, however you describe it, is perfectly capable of making those choices and decisions. But as the wealth gets greater, that gets more complicated. You know, do I need a sailboat or is it a power-driven yacht? You know, these kinds of things begin to come into play, not to mention the added factor of health. 20 years ago, when we worked together,
Yeah.
Health was never an issue. Health was, something that, oh my goodness, I fell and, broke a limb or something. But it wasn't an issue. But, in today's aging population, health has become a major issue, and I think should be integrated in the whole wealth scheme. And in order to do that, you've got to look personally. You can't do that with formulas.
So as you talk about formulas, so many questions are popping up in my head, Lou. One is, when I think about spending in retirement, I think about it as almost a spreadsheet, that it's a row by row, column by column exercise, because you can't do it with an off-the-shelf software program. It's really a matter of a year-by-year exercise in terms of evaluating what your spending needs might be and building in maybe some cushions and reserves for unanticipated expenses, perhaps.
Absolutely, yeah. You're hitting the nail. That's exactly what we're talking about. We're talking about looking at, but not only just looking at it, but controlling, making decisions. Do I want to engage in this activity? Can I afford to do it? So it's really going to the decision-making process that historically has been around investments, going through an orderly, systematic process to make an investment decision. Well, I think you should go through an orderly, systematic process to make a spending decision as well.
So as I think about spending and all the things I've written about retirement and spending, a couple things come to mind. One is, some of the research suggests that people spend less over the course of retirement on a real basis. The folks at the Rand Corporation suggest that it's around 1.8% decline in real spending as you go through retirement. David Blanchett has sort of shown the same thing. Any thoughts about how that should factor into a person's plan?
Totally. What I'm saying is 1.8% is a great average, but 1.8% is too much for 50% of the population and too little for the rest.
Right.
So you've got to make it personal. In some circumstances, it's going to be 7-10%. In other cases, it's going to be, a basis point. So don't get caught up with these ratios and rules, because those are the effects of what decisions were made. Those are not tools to make decisions.
I was going to say, so in terms of decision making, there was an interesting study that was published a little bit ago by Sudipto Banerjee from T. Rowe Price, and what he looked at was spending volatility over the course of retirement. I'm not sure if you saw it or not, but in essence, what he said was that for households with income of $150,000 or less, there was a great deal of spending volatility, usually around house expenses. And then for folks who with household income of $150,000 or more, there was also volatility, but not around essential expenses like housing, but more around discretionary expenses like travel. And in some cases, the volatility ranged from anywhere from 25% to 100% of a person's income in any given year, which is a lot, I thought.
Yes, but I'm not surprised, because factors that go into that volatility are things I talked about before. What's the health of the person? If the person at the lower end of the income spectrum that you're talking about is really healthy, then they're probably not going to be as volatile. If, on the other hand, they suddenly have heart disease and kidney failures and so forth, then their spending is going to be random. That's why I said it's a personal issue. And unless you look at it personally, you're really not serving the population. I contrast it to the accumulation phase, right? You know that anybody who is between 25 and 40, the vast majority of them have to be saving. I mean, there's no doubt that that's the case. On the other hand, as you get older, the choices become real. and are driven by other factors. And that's what I think is so important.
Yeah. So you mentioned healthcare. I love when I talk about retirement planning, living in retirement. I think about all the retirement risks that you'll face and the ways that you need to manage and mitigate those risks. The Society of Actuaries has a great chart listing 15 risks that you'll face in retirement. And I think for me, advisors who look at this chart and say longevity, inflation risk, spending risk, healthcare shocks, et cetera, we've looked at all these risks and here's how we plan to manage and mitigate them for you, Mr. or Mrs. Client. And that to me would give folks a great degree of comfort to know that we've addressed these potential risks that you'll face.
Absolutely. Yes. The risks, I think, are one side of it, but I go back to what are you really interested in? Are you interested in in playing golf, or what are your personal interests? And that's what I'd like to see front and center. By looking at individuals' personal interests and asking them, what is it that you really want to do? Where are you going to enjoy your retirement the most? That, I think, creates the framework for what spending should be.
Yeah. So do you think our audience will be advisors who are members of the Investments and Wealth Institute? They have the CIMA, CPWA, RMA designation. Do you have a sense that advisors are trained to have that conversation?
No, is the honest answer. They're certainly trained in the process that goes through, but I don't think the mindset has been there. The mindset that I need to find out what is motivating that client, that person, what's driving them, what is it that is, they wake up at night, how is their family situation, all of those kinds of things, and be able to lay that into a spending plan.
Yeah. I remember there were some words that when I worked with you way back when, you used to say things like, what keeps you up at night was one of the questions, right, that we would ask people.
Right.
I'm not sure if it's appropriate for this situation, but maybe.
Yep.
Yeah.
Mm-hmm.
So Lou, the other thing that you've been working on has to do with things related to being a fiduciary. We just watched the Labor Department come out with some new proposed regulations around fiduciary. Tell us what you're working on there and your sort of current views on the state of affairs.
Well, one of the things that we, really have focused on over the years is that fiduciary responsibility. And I think as we go forward, and when you look at the Labor Department and what it is that they're doing, frankly, Bob, I think they are sort of attacking yesterday's problem. And, yes, we should be cautious and diligent about the assets that we manage or that we control. But I think what's missing in what the Labor Department is doing is looking beyond that and saying, what is it that the participants in this scheme really need? Another area that I think is really one needs to pay attention to, it goes back to that simple phrase that we all know and love, past performance is no indication of future results. That is such a deceptive statement. And it's deceptive because it implies that you should never, ever, ever look at past performance. Except we always do. What we're lacking is a measure of the probability of that particular investment choice. So if you knew, for example, that the S&P had a 24% probability of repeating the 156% return that was the case for 10 years, you could make, an intelligent decision if you compared it to what the U.S. Treasury did, where the probability was somewhat higher, 36%, but the return was 49%. That kind of thinking, I think, should go into the whole fiduciary issue, so that when you're making recommendations based on things like the probability of return, and not just, some arbitrary number like beta.
So as you mentioned the word fiduciary, I think we have a very splintered financial services industry / profession where some people are beholden to the fiduciary standard, others are not. Any thoughts about how maybe as an industry, like my well-worn statement is, if you had to build this industry from scratch, it would look nothing at all like it looks today.
Oh, totally agree with you on that front. No way would you build that. I mean, the industry today is built around avoiding liability. It's not built around taking care of customers. So, if you start off with what can I do for which I will not be sued? If that's your premise, then what's your purpose? You're not providing any benefit to your investors or to the community. The good news, however, is that when I look forward to what's happening, I see AI, and I imagine AI being the decision-making tool that, for all practical purposes, eliminates the fiduciary liability. So I see, 10 years from now, or maybe it's beyond that the recommendations that a firm makes will be based on an AI principle that can be repeated and given the same factors will always give you the same results, will therefore eliminate any form of liability. But what's most important, it would genuinely be acting in the best interest of the investor.
Yeah. I sometimes think that what's lacking in the profession is what I would describe as best practices, and maybe what you're describing is an AI machine that gives you best practices as opposed to having to, just do what you are legally allowed to do.
Right, exactly. I mean, the best example I can give you is the prohibition of using the word guaranteed in this industry. But there are things that are guaranteed. The United States government guarantees your U.S. Treasury. But if you use that term, there's a fear of litigation, the fear of liability. AI doesn't have those fears.
So, I mean, to me, AI isn't there yet. One of the exercises I do with AI at the moment, Lou, is I ask it a personal finance question, then ask a subject matter expert to critique the answer. And invariably, at the moment, it gets some stuff right, some stuff wrong, and then there are some serious material omissions. So we're not there yet, right?
I totally agree with you. I'm talking about the future. I'm talking about after, AI becomes a household trusted vehicle. Yeah. No, I don't think it's hit here yet. I'm really just talking about where is this fiduciary thing going? And I think, from a regulatory standpoint, they're fighting issues that I don't think really count, because down the road, we're going to find a really cool solution. Oh, by the way, there's another aspect to that crosses my mind, and that is compliance. Now, just imagine a compliance officer within a firm using AI to find all the possible violations. Now, that means that you have human intelligence looking at every transaction, every activity that's taking place. There's no hiding. So watch out.
So is the end game from your perspective where every person who is a financial advisor serving a client a fiduciary? Because at the moment we have fiduciaries and people who are just working in someone's best interest.
I think that the distinction won't exist. Whether or not you are a fiduciary, in all probability, everybody eventually will be a fiduciary, because that's what the customer, that's what the investor will demand. If you can put it this way, Bob, if you take the liability off the table, everybody would be a fiduciary tomorrow morning.
Right. Yeah.
And that's where I see it.
Yeah. I say this too, it's a well-worn phrase, but I think that You would never go to a doctor and ask them, "Are you acting in my best interest?" Or fiduciary. You wouldn't go to a CPA and ask that same question.
Right.
You wouldn't go to a lawyer. Everyone else is acting as a fiduciary for the most part, and the advice industry profession isn't.
Yep.
All right, let's. I've already violated my first rule, which was to spend 10 minutes on this topic. Let's talk a little bit more about the history of Dalbar. And I have to tell you, before we got on the call, I did ask AI, if you were to do a podcast with Lou Harvey, what questions would you ask him?
Oh, goodness.
But there are many of the same questions I would have asked anyway.
Right.
Let's start Dalbar is founded 45 years ago, hard to imagine, in 1976. And maybe just talk a little bit about the history of your founding it and why you started it and the need for what you were doing.
Right. Well, I started Dalbar at a time when the mutual fund industry was something that, the person on the street would say, "What's that?" I mean, it was an unknown. Yeah. I personally knew at least half the people who worked in the industry at the time. It was that small. Yeah. So at that time, literally the first thing that we ever got engaged in once we formed the company was this idea that somebody had that they would be able to pass the tax advantage of municipal bonds to the investor. In other words, muni bond funds didn't exist. So we did some research and couldn't find any reason why they couldn't, and supported that. And that led to, oh, wow, let's go look for areas where there are opportunities, where there are things that can help the investor, can help the advisor, help the institutions move forward, that are on the table for free. I mean, it's not something that, you don't have to find a Peter Lynch to do the muni bond solution. Right. Everybody can do it, and in fact, everybody does. So what we have been doing over the years is really looking for various opportunities, looking for areas where we can add value. So we find that value proposition and then work with firms, with advisors to enhance that value so that there's a return for whoever our customer is, the individual advisor or the institution, and for us.
Yeah. So there are two research reports that are near and dear to my heart because I was part of the launch of them. One was QAIB, which has been a long-standing research project, often quoted by people in the industry. Talk a little bit about, one, its beginnings and today its use and value.
Oh, sure. Well, we had a survey, we did a sort of consumer survey and some research several years ago, and it was evident from that study that investors thought that they were earning a lot less money than the funds were reporting to them. So, an annual report might say, the 10-year return on this particular fund is 17%. But the investor said, there's no way in God's green earth we're making 17%. The point is, what he said was, well, that's probably because of your trading activity, which the individual doesn't count. So we came up with a scheme to look at the activity and put that in the context of the return. And everybody, I think, in the industry agreed on day one that investors did the wrong thing at the wrong time. What we didn't know was how much. What does it cost the investors to do that? And that was the point and origin of QAIB, to quantify that behavior. There has been, as you said, it's been quoted for a long time, very often. Sometimes people will challenge the returns that we calculate, but my whole thing is that's not the point. Everybody agrees it's large. regardless of how you do it. So we endorse all of the methods that have come since QAIB, asset-based, asset-weighted returns, and there are other schemes that have been used, all leading to the same conclusion, but all because the methodology is different, all coming up with different numbers. So it's something that is, I think, made quite a big difference in people's lives, and as evidenced by the improvement over time of investor return that we've seen in QAIB. So I feel, really good about the effect that it's had.
Yeah. I want to talk about the effect on raising the industry standards in a second, but first, there was a study that you and I had worked on. We had received a SEC no action letter back in the 90s where the SEC allowed us to do surveys of an advisor's clients and then rate them with respect to trust, satisfaction, share of wallet, et cetera. And at the time, it was groundbreaking. It was, for the first time ever, advisors were able to at least share what their customers thought of them on a large scale. Fast forward here to 2023, the SEC has changed the testimonial rule. Advisors can now provide testimonials by individual customers, and it's really interesting how that has changed. But I still think what was done back then was groundbreaking and still could be of use and value to advisors and potential clients.
I totally. But if you notice, the new SEC rule parallels the no action letter that we got. So what they've done is they've codified into the regulation that which was the no action letter. And the opportunity is there for advisors to use it. Again, there is this fear and trepidation about liability that is so pervasive, and it drives the industry. So, I think to a great extent, the SEC's marketing rules haven't been adopted with the vigor that was anticipated, simply because everybody's looking for a case history which will indicate whether or not there's real protection in the SEC rules.
All right, so talk a little bit about some of Dalbar's biggest accomplishments and the impact you've had on raising the standards in the industry.
Wow.
In 60 seconds.
In 60 seconds? And condense 40-odd years into 60 seconds. Thanks, Bob. No challenge there.
We don't need a soundbite.
The whole story. Well, maybe it's chronological might be the way to do it, and then I can skip through things. One of our first initiatives had to do with technology. And we were a lot on technology in those early days. One of the things that we worked on, and I think was instrumental, was a settlement system, where in the old days, mutual funds used to receive calls from brokers over the phone, write them on a piece of paper, call the broker back on the phone later in the day, tell them what the price was, settle the trade that way. Okay? At the time, we said, this is crazy, because as the volume grew, mistakes grew, errors occurred, the whole 9 yards. So the decision was made in the industry to introduce an automated system for doing that, where the orders would be transmitted electronically, confirmed electronically, and that process is something we were really involved in and became active in, and is now something that nobody even thinks about. You don't think about pricing a trade wrong. What? How does that work? Yeah, so that was one of the early things. Another thing that crosses my mind as we talk about this whole thing is the service side of the business, and that is, how do we serve the needs of that end customer the best? And one of the things that we found is the service at the time was through the mail. So if you needed to correct an error, you'd write a letter to the firm saying, you spelled my name wrong, or I need this information, and a week later you'd get a letter back. We decided that one of the areas of improvement had to do with the phone. The more you could do over the phone is the more responsive you could be to customers, and that would be the formula for growth. If you're going to grow your business, you better be able to serve your customers effectively. So we set about establishing standards, criteria for how a phone center or how the telephone should be handled. And as the capabilities were added to the phones, because it also means that you had to do more things on the phone. If I needed to change an address, I don't have to be able to do that over the phone rather than writing a letter. So the scope of the phone activities changed, and the quality of that exchange continued. And that initiative continues to this day. We're very aware of that. And another magic thing that we discovered in doing that is the issue of recognition. If the individuals doing the work got recognized, if the firms who performed well got recognized, they would strive to do better. And I think, one of the things that you can see today is that the service that you get over the phone from mutual fund companies or insurance companies or wherever in the financial service industry is so far superior to almost anywhere else. You call in the mutual fund industry, when would you ever hear somebody say, all of our lines are busy, we'll call you back in 3 days?
Right.
And that has become the norm outside. So that, I think, is an outstanding aspect of it. And it makes sense because, on our side of the world, on the investment side of the world, this is a large chunk of money for that individual. So you should treat them with proportionate respect. Yeah. So I don't know. I guess I could ramble on.
But like I said, that leads to, I think, I've always had this. I've always described you and Dalbar in two ways. One is magicians at needs-based selling, which is a client has a need and Dalbar is able to meet that need. The other is I've often described it as lead-based selling, which is that you're leading the industry to a place that you think it's going. And so to maybe talk a little bit about where you think, one, Dalbar is going, and then two, where the industry is going.
Okay. Well, where Dalbar is going is we have a few things that are in the pot right now. I referred to it. One is the reliability of past performance, and we've talked to the regulators about this as well, that instead of simply saying past performance is not relevant, you go the other route and include with the disclosure of past performance how reliable it is, because it's absolutely measurable. That kind of disclosure, I think, would change and protect to a great extent the actions of people in the industry. So that to me is is something that we're working on and really are, I think, maybe small, but it can have a huge impact. A second thing that I think is one of those needs that you referred to is asset allocation. The cost of asset allocation is enormous. One example I can give you is if we look at a $1,000 investment in the S&P 500, 40 years ago, that would be worth about $5.9 million today. The 40 years being the working lifetime period. That drops $2 million if you had 40% in treasuries. Right. So what that really translates to, Bart, is you're spending $4 million because of the 60-40 allocation, without regard for whether you need that 40% in treasuries. That and a process to change that, to change asset allocation from being something that is an arbitrary percentage based on rational or irrational factors, and really making it something that is determined for the individual and their situation. I mean, how does it make sense in what I'm talking about? For somebody who is 25 years old, putting 40% of their 401k in treasuries that they're going to need in 40 years. Yep. You know, what? Right. It makes no sense. So that is an area that we're actively working on right now, and are looking for people who see this problem, who see this need, and would like to work with us on bringing this, to reality.
So before you go on to mention anything else, but I'm thinking that the industry, the Labor Department, and even consumers, investors, 401k plan participants have gravitated toward target date funds. And presumably if you're in your 20s and you have an allocation that's more 90% toward equities versus 60%, you're more likely to achieve your goal, or are you not a fan of target date funds?
Target date funds, unfortunately, are arbitrary. It's saying every 21-year-old person should have, did you say 20%? 20% in bond. What? How can that be? I've got rich 25-year-olds, I have poor 25-year-olds. That's the problem. And so I think target date funds are fine if the targets are dynamic. And there are firms who are doing that, and they're doing that right now. Instead of simply saying, this is your target date because you're this age, it turns it around and say, well, let's establish what your need for protection is. And if you have no need for protection, then it should be 0%. If on the other hand, you have parents who are in the hospital and you're taking care of children and all of those complications, maybe you should have 100%. It's that factory mentality is what I call it, that we're really trying to see if we can turn around. And I think, as I said, the factory mentality comes from the fear of liability.
So when I think about the factory mentality, I think, okay, so the industry has tried to shrink wrap the solution because that's the only way to scale it, right?
Right.
To personalize it would be labor intensive and perhaps costly, or not, maybe.
Well, it's costly if you assume that you're going to do it the hard way. If, on the other hand, you ask, 3 questions of an investor and you do it electronically, it doesn't cost you squat, if you'll excuse my French.
All right, let's talk a little bit about the future. A couple things on my mind. One is we're seeing a lot of consolidation and a lot of activity by private equity firms in this world. Is that for the better or for the worse?
I think it's for the better. Partly because what the world, I think, the ideal world as I see it, is you have growth and wealth management and you have spending management. And as the industry consolidates, I think you're going to have a gravitation towards those two. You're going to have banks and insurance companies becoming more effective at preserving capital and being prudent about that. And investment companies will be taking risk and separate and distinct from their investment returns. So as this consolidation takes place, I see these firms breaking into those major segments, unlike 30, 40 years ago when they were trying to put everything together. So, a firm would be a universal product provider. I think that's going to change.
So there's another trend that's going on in the industry. One is this notion that it's better to service ultra high net worth clients, and that to do so you need a team, and on that team you need specialists, an estate planning specialist, an income tax specialist, a retirement specialist, et cetera, et cetera. Any thoughts about that as a trend?
Yes, I think it is really valuable, but watch out for AI. Once you've got AI working, these specialties become less valuable, and the interaction with AI is where the value occurs.
Yeah. So does that speak to someone who has general knowledge and relies on AI to deliver the specialized advice?
Yes, that I think is the payoff. That's where the great opportunity lay. Right? For somebody to be smart enough to calculate RMD in a particular situation really isn't an added value. You can go. You don't need AI for that. You can go to a computer today and get that. So that kind of specialized knowledge, I really think, will not maintain the value that it has today.
Yeah, and it's interesting. I'll just mention estate planning. Right, there are maybe 50 estate planning tools that you could use. Right,
yeah,
Kratz and Slats and irrevocable trusts and insurance trust, et cetera, et cetera. Knowing which one to use for which asset and under which facts and circumstances today is critical for someone who is an estate planning specialist. But if AI can do it,
that person can take a vacation.
That's hysterical, Lou. So, I guess if I was in that person's shoes, I would be developing AI as fast as I could so I could get to that vacation.
You bet. And the opportunity is great for educating AI.
Yeah. All right. So what else do you see coming down the pike that financial advisors should be especially on the lookout for? Opportunities, threats?
Well, the biggest threat I think that advisors need to be looking for is the ability to review and examine records. It isn't far from us where every disclosure, every conversation, every email will be subject to regulatory review. That says you won't get away with anything. So advisors begin to think about, your practice in terms of making it squeaky clean. Because
well, it's interesting, right? We often say that there are a few bad apples spoil it for the vast majority of advisors. Those bad apples will be gone, perhaps.
Yeah. You got it.
All right. All right. Lou, we have covered a lot of ground in 43 odd minutes or so. I'm sure there's stuff that we've missed or that just bears reemphasizing. You get the final word. What else?
What else? Yeah, I started with this and I'll end with this. Make it personal. Make it personal. The relationship with the investor isn't part of a formula, isn't some generic rule or ratio or anything like that. It's all about that particular individual, and that won't go away. I don't think an individual will become friends and trusting of a AI or any other technology solution as they will with the person that they have that trusted relationship with. So make it personal.
Lou, I can't thank you enough for joining me and sharing your knowledge and wisdom and sharing old times with me. I really appreciate it. And I hope you'll come back on a future episode when we can maybe talk about things we didn't get to today.
Great. Thank you, Bob. I certainly enjoy it and sort of reminiscing the old days. Thank you very much, and we'll talk to you soon.
Thank you for listening to the Exceptional Advisor podcast, brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.
Join us at Investments and Wealth Experience 2024, the year's premier event for wealth advisors and thought leaders from across the investment industry. The event connects advisors focused on expanding their knowledge, businesses, and network with wealth management's most successful and engaging thought leaders. Over 3.5 days, more than 1,000 industry leaders and advisors will gather in Las Vegas, a city known for never standing still. Attendees earn up to 21 Premier CE credits. Early bird pricing ends March 8th, so register today at www.iwicentral.org/experience24.